Welcome to another Liz Biz Academy lesson. So, you've got your team set, your compliance accounts are totally good to go, but now you face an operational decision that is absolutely vital to the health of your business. It dictates both your weekly cash flow and, honestly, your administrative sanity. We're talking about choosing your payroll frequency. It sounds super simple, but getting this wrong can cost you dearly in both time and money. To build your complete strategic guide, we'll quickly cover the rookie payroll trap, look at the 4 standard cycles, break down the 26 versus 24 blueprint, map out the 3-paycheck forecast, and finally lock in on the overtime alignment matrix. Let's get right into it.
Starting off with Section 1, the rookie payroll trap.
So many new founders fall right into this one. They just kind of pick a schedule completely at random, or even worse, they let their new hires dictate the terms. The usual assumption is, hey, paying people weekly is a fantastic way to boost team morale, right? Well, sure, but making that choice unknowingly locks you into a perpetual, grinding administrative loop. Doing payroll every single week literally devours your processing time, shifts your focus away from actually growing your business, and drastically spikes your software transaction fees.
It's honestly wild when you look at the sheer volume of wasted time here. With a weekly schedule, you're essentially paying your payroll provider and taxing your own precious schedule 4 to 5 times a month for a task that could be done in half the time with an optimized cycle.
All right, moving on to Section 2, the 4 standard cycles.
So, what are your actual options in the commercial landscape? You've basically got 4 standard cycles you can deploy: weekly, bi-weekly, semi-monthly, and monthly. Now, we've already tossed out weekly because it's a massive resource drain, and monthly, that's usually way too long of a wait for typical employees to maintain their own personal cash flow. So that really leaves us with the 2 heavyweights right in the middle.
But here is the absolute most dangerous error you can make, and one that will completely distort your corporate budgeting models. It's confusing bi-weekly with semi-monthly. People toss these terms around at cocktail parties like they mean the exact same thing. But in business operations, they are entirely different beasts with massive financial implications.
Which brings us to Section 3, the 26 versus 24 blueprint.
Let's crack open our knowledge toolbox for our first tool to clear this up. This is where we separate the amateurs from the pros. Okay, so a bi-weekly schedule means you pay your team every other week, like clockwork. Because there are 52 weeks in a year, this results in exactly 26 pay periods, period. Semi-monthly, on the other hand, cleanly cuts the calendar into exactly 24 pay periods. You pay your team on 2 fixed dates every month, typically the 1st and the 15th.
And why does this matter? Well, semi-monthly schedules perfectly mirror your standard corporate overhead. Think about it. Your commercial rent? Due monthly. Your recurring software subscriptions? Billed monthly. When your payroll hits on 2 fixed dates every single month, your cash flow forecasting becomes incredibly predictable. It just locks right into those neat, reliable 30-day corporate cycles.
Next up, Section 4, the 3-paycheck forecast.
Now, you might be wondering, if semi-monthly is so remarkably clean and easy to budget for, why don't we just use it for absolutely everything? Well, it all boils down to this number, 2. Exactly 2 times every single year, if you're on a bi-weekly schedule, you are going to face a 3-paycheck month. Because bi-weekly runs on a strict 14-day cycle, those days eventually stack up and a 3rd payroll run lands smack dab inside a single month. If you fail to forecast properly using this model, those specific months are going to create a sudden, massive demand on your liquid cash reserves. It's a classic trap that catches thousands of business owners off guard every year. They cruise through month 1 with 2 paychecks, month 2 with 2 paychecks, and then boom, month 3 hits. They check their bank account, see rent is due, but suddenly they've got a 50% spike in their payroll expense for that month. You absolutely must insulate your accounts for these spikes if you run a bi-weekly schedule.
All right, let's look at our final tool in Section 5, the overtime alignment matrix.
So how do we actually decide who gets which schedule? This comes down to one last major compliance headache: hourly workers tracking overtime. The stark reality is, hourly workers find semi-monthly schedules incredibly confusing. Because it's tied to calendar dates, like the 15th, those dates are constantly shifting days of the week. That forces your payroll software to calculate these really complex mid-cycle hour splits, which completely scrambles their overtime metrics and causes constant administrative headaches.
And this brings us to your final operational protocol, the overtime alignment matrix. To run a fully optimized operation, your salaried employees, whose pay does not fluctuate, belong on semi-monthly schedules. That perfectly streamlines your corporate overhead. However, your hourly workers must be kept on a strict bi-weekly rhythm. This ensures that standard 40-hour weeks are beautifully captured, it tracks fluctuating overtime without complex calculation errors, and most importantly, it keeps you fully compliant.
As we wrap up this Liz Biz Academy explainer, I want you to take a look at your newly structured operational calendar. You've got the 26 versus 24 blueprint, the three-paycheck forecast, and the overtime alignment matrix right in your toolbox. But knowing the theory is only half the battle, right? So ask yourself this right now. If you employ hourly workers on a bi-weekly cycle, is your liquid capital truly prepared and insulated for the sudden cash flow spike of your next three-paycheck month? It's time to check those reserves and build your optimized payroll engine.